All right. So I think the first topic, as we just had this election, and it was, we were either going to pivot one way or the other. So obviously, we're pivoting toward a Republican-led, pro-growth, lower taxes, and it's going to be a fuel for revenues to grow, interest rates to drop, in general, a preference toward equities and other investing classes. So I'll get into that, to kind of get started. And I think, Scott, you bring up a good question, which is, what's that exit strategy look like? And that's very different from investor to investor to investor. And I'd love to talk about that because I think it's an important one, because I think it should also be part of the mindset of a long-term investor is, when do I want to take that cash or take that capital and do something with it in life? It might be buying a home. It might be, hey, I want to take a year off and I want to travel down with Tomas down in South America and go to Patagonia and spend 6 months there, then go spend another 6 months somewhere else. There might be something as an outcome that you're looking for. So when do you have an exit plan, and that is maybe driven by some life event, but it really is met with good homework on the investor's side, with a good approach to, leave at the right time under your conditions or your preferences and successfully. So we'll get into that after the first topic. So we had a huge election, and the good news is that the election happened, and when Donald Trump won, it was clearly a decision that the voters made, and the Democratic nominee conceded, and the transfer of power is in motion. Okay, good. There isn't going to be a big, long-lasting court fight and that kind of thing. So that was very positive. In addition to that, in Donald Trump, you're going to see a leader that really pushes. I think one of the, I would say, if you were to ask Donald Trump, after 4 years, what do you want your legacy to kind of sound like? Very near the top, if not the top item that he would probably say is, I want people to remember me for how good the economy and how good stocks and how good the investor did, how good wealthy people did. That's probably near the top, that, hey, people under my presidencies became better off economically. His measure is economics. And I think other leaders have different economics, but different measures, I would say. Having said that, I think that's really going to be a tailwind for stocks, real estate. It's going to be a tailwind, and it's a very small asset class, but cryptocurrencies. It's going to be a tailwind for acquisitions and mergers. It's going to be a tailwind for small cap stocks. These areas are going to really thrive. The one area that I really wanted to dive into is small caps, because I think I'm going to show you a couple of graphs and share with you like what I'm seeing, what I expect going forward. And what I'd like to go through is, okay, so I'm going to first rationalize that, hey, I think small caps are going to continue to do well. They're already doing well. How do I find a couple more small caps? And putting a little bit of research into that. I was just started the research, so I can kind of do it on the fly with you guys. Once we finish this kind of conversation around, okay, we have a new president. What are the asset classes that are going to do well? We'll dive a little deep into small caps, and then we'll come back to the, hey, when is the right time to exit some of my investments or my investments? And we'll take on that topic. All right, so let me share my screen here. And before I jump into this here, I'd love to hear what you think, the election is going to cause specific to stocks. Do you think, I shared my opinion, but maybe you guys have more to add, or maybe you have a different point of view?
Yeah, well, I think we've seen a lot of it already, right? Look at the rallying that's happened. And so a big part of my portfolio, I want to say, 8 to 10% is, I do have a couple separate small cap stocks, but a big part of my portfolio is AVUV, which is a small cap value fund. Actually, you might want to check it out just for ideas, because it's kind of an actively managed ETF that they use value investing for, investing principles.
Give me that symbol again.
Jumped AVUV, like AVUV. And it's from Avantis. And yeah, and they update it. I should say they rotate it fairly regularly. So it might be good just to keep your eye on it. It's pretty diversified too. And yeah, so that jumped to a level I haven't seen since I bought into it in like the beginning of the year. The one thing I would add is at the same time, we should not forget about the valuations that were already kind of getting out of control. And like, yeah, maybe the fundamentals will also be improving, but I think the valuations are just going to get even crazier
I agree.
going
I
forward.
agree.
So let's not forget about that.
Yeah, I agree. Um, and before I comment again, anything else you would want to add, Tomas?
About the last point that Scott made, I believe the same. Valuations are going to the roof, and it's very hard to find something that is not some stock that is cheap valued, but other than that, I'm just expecting. I'm just waiting.
Yeah, I agree. I agree with Scott, and I agree with you, Tomas, that valuations are really high. And I think we've been communicating with one another for months now, if not longer. And I think you've heard my comments where I'm looking at this market going, okay, it's been going up really nicely, but all things must come to an end. Valuations are too high. And I think we're in a very expensive market. What's 2025 going to look like? I think the market's going to push higher. Are we going to meet another year like 2022? Absolutely. We're going to have a year where we're going to have a correction. And actually, this was a conversation piece that I had with a group of friends earlier today. And what was on their mind was, this is just too good. And I think we're going to have a correcting year. And I said, yeah, absolutely. I completely agree with that. Just the hard part is, I don't know when. I don't know if it's going to start in a quarter, in a year, in 3 years. I suspect that we can't get, if we got through the next 5 years without a year where you had a correction like 2022, I'd be really, really surprised. I think there'll be an event, there'll be kind of a combination of things. There'll be maybe 2-3 different events that cause the market to really begin to sell off. And then that momentum downward is going to cause a lot of investors to accelerate their exit out of positions. So, that's where we're at with an expensive market. But let me go on and talk about small caps and kind of show you a couple graphs and show that, hey, there might be a couple companies out there that are going to do well. But I do agree in general, especially if you look at the big expensive stocks, any stock that's valued pretty much above, I would say 300 billion in market cap, it's really hard to find really discounted companies. But as we look at small caps, and if you look at my screen, the Russell 2000 over the past year has outperformed the S&P. But over the last 5 years, it's underperformed it substantially, especially if you look at coming out of 2022, the market, if you look at the S&P, it really went up nicely. But if you follow the blue line, which is the Russell, compared to the gold line, which is the S&P, the Russell was really fell behind. It's just been behind for a while. But this past year, and especially this past week, it's pretty much caught up. It's caught up to the S&P. It's actually just, surpassed it. And I think surpassing it because it started with what I believe was a discounted level. It was unappreciated. The small caps were unappreciated. A big part of that was that the Magnificent Seven, the FANG stocks, the big caps were just taking so many of the investing dollars that it left very little for small caps. So I think there might be an opportunity to find a couple of good companies that I could invest in, that investors can invest in the small cap segment. So what I'm going to do is I'm going to look at first, what do small caps look like and what's that definition? I believe small caps now, because stock prices are so high, is a company under 20 billion. I mean, we're no longer a small cap is like a $25 million market cap company. Companies are so valuable now that getting to $1 billion valuation that's a small cap now. And so I'm going to consider small caps being under 20 billion, just from my thought process. And I'm gonna look at two categories, which is small companies under 2 billion, really small companies, and then small companies under 20 billion. And you can run stock screeners. I think this is the stock screener that I ran with stock analysis. And this is really the starting point. And I like their tool because it gets me, the stocks based on a couple of filters. I'm using market cap as a filter, the PE ratio under 20, and then a free cash flow yield above 5%. And that's kind of a good list to put out. And I'm going to put it out into a sheet that I could then further look at, because I want to stay away from some industries. For example, broadcasting. I want nothing to do with traditional broadcasting companies. I think they're just fading away. They're not going to exist in the future. So I'm going to go through this list and pick out, like, everything is a maybe, but I'm going to go through and try to pick out a couple of good companies and good industries that I think are going to do well in 2025 and maybe even into 2026, and then go through my process of looking at their revenue growth, looking at their free cash flow, and if it's going to do well, looking at their industries. Is the industry going to thrive, or is it going to be held back? That's going to be important because I think the Trump administration is going to favor some industries and probably hurt others, right? Like solar stocks really sold off this past week because it's not expected that the Republican administration is going to be, really willing to do a lot of things for renewable energy. And some industries did well, like oil stocks have really begun to work. Financials just boomed this week. Banks, I think it's an expectation that there's going to be less regulation. So there's some industries that are really being helped with this new administration. And in general, I think that acquisitions and mergers are gonna be really high in 2025 and 2026. For first, the reason being that the Republican administration is probably not going to block mergers, and they're not going to give companies a hard time for being monopolies like the previous administration was doing. They were a little bit tough on companies, and I think it maybe scared some mergers and acquisitions, away. But I think the new administration is probably going to favor that, and it's going to probably drive more of that, which is going to help small caps, because it's usually the small caps that get acquired. You're not going to. Go ahead.
Oh, Victor. Yeah, I also agree with what you said the other day, that we are probably going to see more IPOs.
Mm-hmm.
And the example I gave was Kraken, which not is just any company, it's also in crypto space. And so that's a double whammy there, right? We're going to see crypto flourish, and we're going to see IPOs at least flourish more. Also, I put a link to that ETF in the chat.
Thank you.
Mm-hmm.
So there's two ways to look at it, and I'm glad you brought up the ETF. That's the magic of having an investing community. Is I didn't think of an ETF. I was kind of going to do it the old-fashioned way, which is harder. Go find some stocks. Let's take a look at that ETF. Let me look at the chat.
Yeah, I think it's a pretty interesting ETF because it. If you want to hold it yourself, it's or if anyone wants to, it kind of combines the best of actively managed fund with the best of a passive index one, because they keep a pretty darn low expense ratio. It's 0.25. I don't know if I've seen anything else that's active with something that low.
Yeah, I like the idea. So very low. So the expense ratio is really important, and the reason for it is there's really no reason why an ETF manager needs to charge a high expense ratio. Everything's so darn efficient now. The computers, they do a lot of the work. So if you're paying an expense ratio of like 1%, I would, if you're paying into a fund manager that's just consistently beating the market, okay, totally understand. And please share that name with me. I will gladly pay 1% management fee if it's somebody like Warren Buffett that's managing that fund and consistently beating the market. But the reality is that's not the case. Like, very high percentage, like 80-90% of these fund managers do not beat the markets, but they do a good job. And I think 25.25% is a very reasonable cost. All right, so these guys, let's take a look at, I'm sure the performance for year to date.
Yeah, performance has been pretty meh, except for a little bit in the middle. But yeah,
go
ahead.
I would say that this information is dated. They're probably, you have to give them a quarter. This isn't showing like what we just saw this past week. But annual return looks good, 30%. 5-year, 15%. You see that 3-year. That's where that lull in small caps is showing up. And to me, that's an opportunity, right? It's kind of like, hey, the market was bad for small caps 2 years ago, but now the market's really good and we're starting with a lower price. So we could say that the market in general is expensive, but I bet you if we look at some small caps, there's probably some discounted industries that are going to benefit under a Trump administration.
Yeah, and if you look at their portfolio and the top holdings, I find that pretty interesting because right now the top holdings are mostly in like industrials, financials, like Jackson Financial, I think.
Financials number one, industrials, consumer discretionary, energy, materials, technology. Very, very good.
If you go down a little bit, you should see the top 10 holdings.
100% in the US.
There's a little bit. There's like a couple companies in Brazil.
And then minus 1% in Brazil. How do you minus 1%? That's funny.
I think it's less than 1%, but
okay.
Yeah, so I just find this is interesting. The mostly industrials and energy.
So Matson. So this is probably a cheat code to investing. If you look at a good ETF and you're like, okay, these are educated professionals that really know what they're doing. Why don't I go look at these companies? This is a cheat code. This took my process and said, yeah, I could do it this way. And maybe after a few hours of sweat equity, I would get to a list. Well, hey, cheat code, start with this list. These guys already put in that time and energy. You can still look at them individually and see what you think. And look at this ETF as a possible investment in itself. So, all right. Let me also look at within stock analysis, AB. So this is 15 billion. Okay. And
actually, Victor, here's a question for you.
Uh-huh.
So airlines,
Mhm.
You think airlines might do better in the coming year or two?
So, maybe shame on me. I thought airlines saw their businesses thrive in 2023 and 2024. And they may continue to thrive into 2025. But Warren Buffett swore him off. I believe he's like, I will never buy an airline again. He did, his airline stocks underperformed like in the 70s and 80s, and he swore him off. And I thought, well, I get that, but I thought coming out of COVID, airlines are going to thrive. I was correct from a dollars and cents perspective. Their revenues are off the charts. Their expenses are controlled. Their profits are excellent. You look at their PEs, they're ridiculous, but the stocks didn't do anything. And I'm like, well, geez, if the market's not going to pay for airlines, I don't know that I want to be an airline investor. So I got out of United. It underperformed. I didn't lose money, but it left me with the impression that you don't know what you're going to get out of an airline. You may be in it for 5-10 years and walk away with a very low return. So that's what I observed. What are your thoughts?
Airlines, that's tricky. I don't know how much I could comment right now, except I just thought it was interesting that if you look at that,
of course, I got out of United, and look what it did.
Yeah, we all have that moment. One of the top holdings in this ETF is Alaska. That's what made me want to ask. And it's interesting that they see that potential in Alaska.
Yeah, I got out of United at the wrong time. I didn't stick around long enough, but you look at the 5-year, right? That's eye-catching. But I thought, coming out of COVID, we would see airline stocks thrive, like their revenues are growing, everything's good. And I gave it like a year and a half, 2 years, and it just didn't do anything. And I'm like, finally, okay, look, it's not doing anything. I'm going to get out of that and get into something else that's going to be rewarded by the market. And it certainly worked for the last couple months. But I would still hold my reasons for getting out of airlines. I would be like, I'm still not an airline investor. It's an undesirable business if you look at it conceptually. So I still feel the same way.
There's other ways to invest and make money in this space, though. Like, for example, if you look at something else in that list, there's Air Lease Corporation. So that's a company. It's AL, ticker AL. So they they purchase and lease commercial jets to airlines. So United, for example, might actually lease airplanes from this company. Or you could invest in certain airports themselves, like I mentioned the other day.
Yeah, and I like that idea. Now, I think the travel industry, airlines, are going to do well in 2025. So I'm going to look at AL, and I don't know about airports. I'll take a look at that. I'll take a look at that in my own time. This is a good idea. Air lease, it's up 29%. It's breaking even over the 5-year. See, you would think that. Yeah, I mean, this year was really bad. I mean, the COVID year was brutal on airlines. So that's what's held this stock back. Yeah, good idea.
Yeah, that one's 5 billion. So is that a micro cap at this point?
I know. That's not a bad idea. I'm gonna look at that. So this is a good place to look at small caps, because I think small caps, if we're looking, and let's talk about, like, if you're a younger investor, looking at you, Tomas, right? I would imagine you're investing and saying, I really, putting myself, I think, in your shoes, which I'm going to guesstimate you're 30 years old or so, or 28 years old.
32.
Yeah. And putting myself in your shoes, right? In those years, I was making as much money as I could through my career. I was investing in real estate because I thought, it's important to own real estate. And I was just putting money into stocks. And my aim was put into growth. And I may have a couple bad years, but I'm going to have a great return over the next 25 years. I don't need the money for 25 years. I could have a bad year next year, and it's like, hey, I'm going to put more money in. So that was my mentality. As you get older, now I'm 56. When I look at the market, I kind of am also looking at, okay, is this market really expensive? And do I want to start moving from stocks to an alternative asset class, bonds, or even crypto, but small amounts in crypto? But that's not for your consideration. I would really encourage you to stay on that growth path. If you put in $1,000 today, I hope you invest it and you get a rate of return of 20% a year for the next 20 years on that money. And you wake up 20 years later and that $1,000 is worth, $35,000. And you're like, great, I'm glad I went into growth because I just really grew my money. As opposed to me, I'm like, okay, well, what am I going to be doing 20 years from now? I'm probably going to still have a YouTube channel, whatever we're calling it then. Might be YouTube or something else. Maybe the metaverse will finally become something. And I'm beginning to think, okay, I want to be comfortable. I want to take care of my family. So I'm going to always be into stocks, but I'm going to not be 100% stocks, not be 100% risky assets. And I'm going to put more money into bonds. And I don't know if, the cash is going to pay very much in the future. So I don't know how much I'm going to put there. But that'll be kind of a back to exit strategy that we talked about earlier. My exit out of some stocks is to move into bonds, which is a very stable investment that if you buy it over time at the right times, you can do well with, but you're not going to match stock returns. You're just going to have a nice return, 5 to 10%, but it's going to be stable. So if the stock market crashed in 2025, my bonds would look so good because they're probably going to go up 5, 10%, while the stocks are dropping 20, 25%. And you're like, oh man, I'm glad I've got some bonds because that's the money I'm going to live off of for the next 5 years in my case. So then I could wait for the market to correct itself on the stock side and then exit out of some of those positions when the times are more favorable to sell those stocks and move them back into bonds. So, so this is a great place to kind of end the little discussion point around. Go ahead, Tomas.
So you recommend me to not sell, to keep going on with growth.
Yes.
But what do you think about, for example, Chinese stocks in the long run?
So you asked me 2 questions. The first one is a yes.
Okay.
So the first one is keep investing in growth. Okay. Meta is one of my big positions. It's the biggest position. I'm not selling one share of Meta, and I'm 56. Now, if you were in, you have your favorite growth stocks in general. Now, if you still believe in those businesses, you still believe those are great companies, I would not be selling one share. And I would, in my case, I like to dollar cost average into stocks. I would consistently buy, I would say carefully buy in an expensive market. If we have a correction like 2022, I would not sell one share of my stocks that I believed in. And I would actually try to find ways to make more money so I can put it into the market in those bad years when the stock market sells off.
Okay.
Now you asked the second question, which was, what about China? Well, so I think China's going to do well, but I also want you to think about two other regions, which is India and Mexico, as well as Latin America. And is that what you call it in Argentina? We refer to Mexico, Central America, South America as Latin America. Is that what you refer to it from Argentina?
Yeah. We usually call Latin America the Spanish-spoken countries, but Portuguese from Brazil is a Latin language, so it's okay. Yeah.
Okay, very good. So China's good. I'm going to explain why I think China's good, but I'm going to also explain why Latin America and why India. So first, China. China's going to do really well. I just saw a report where Toyota is moving a lot of their production to China to take advantage of China's very strong manufacturing capabilities and take advantage of the low cost of labor there. So high specialization, quality is high, and they can lower the prices. So Toyota is moving in. So the US and China are going to have tension. But that doesn't mean that China can't sell EVs and products, and their EVs are really good and they're really cheap. They can sell them to India. They can sell them in Europe. They can sell them in Africa. They can sell them in South America. They're already selling them in Mexico. Now the US could say, oh, we're going to put a big tariff on them. That's fine. We're going to sell it to the rest of the world. The US is not the only country that drives cars. Then we can go on to other categories. So I think that the US is, if things play out the way they're expected, which is it's going to be a struggle of tariffs between the US and China, it's really going to be a story that the US press is going to follow. But I'm also looking at China as, the rest of the world really views China as the least expensive place to get stuff manufactured. And it's good for their people. It brings down inflation. People can go, if you go to Walmart, most of the stuff's made in China there. If you go to Target, same thing. So we'll see how things play out against the US, but I still think China's going to do well because they're going to sell to the rest of the world. Go ahead, Scott.
Yeah, I just wanted to add to that. So, the EU has their own difficulties, you could say, with China, and have, for example, put some tariffs on Chinese car manufacturers. But some manufacturers are already finding ways around that and through it. Like, for example, BYD, which also is the battery company, they are now building a factory in Hungary.
Correct.
So yeah, it's more Eastern, but it is EU. And so that way they can get around the tariffs. And I think that that's just the first of many we're going to see.
Yeah. And, I think cars are a very protected industry. But if you move away from cars, right, let's say computers and semiconductors, well, not semiconductors, but let's just say computers and electronics and shoe wear and apparel. Those categories are huge, and China's got them. They've got that market kind of cornered. So for those products, right, I know China's growing so fast in Mexico. And so I think that those are my comments on China, Tomas. Now let me talk about the two regions that I think I'm going to start doing more homework on is Mexico as well as Latin America, because like Scott just said, the tension with China is going to drive Chinese companies as well as other companies to set up in Mexico and use Mexico's more desirable trade relationship with the US and then, set up a manufacturing plant, manufacture your cars or products in Mexico. And then from there, both they're consumed in Mexico and they're exported into the US. So I think Mexico is going to continue to do well. Their economy's been doing well. And I'd like to find a few stocks, if not maybe an ETF for Mexican companies and maybe Latin American companies. So that's the second area that I would say that's not a bad idea to think about. And then the third being India. India has really advanced. And with regards to technology and some sciences like life sciences, pharmaceutical, India is really, really strong. So I'd like to get more familiar with India. And again, maybe invest in an ETF that focuses on India and see if I could make a little bit of investment in the Indian future, because I think their future is bright. So those are the three areas outside the US, China, Latin America, with Mexico being the big kind of for me, it's easy to understand because I am Mexican and my I have family in Mexico, and I'm aware that there's just the trade between Mexico and the U.S. It continues to increase very fast for Mexico, because for good reason. It's a near shore. So go ahead, Scott.
One other point I would just like to add. So another advantage of looking outside the US is the valuations. So even the Swiss market, even though it's not a cheap country to invest in, the average price to earnings is just much lower here. I mean, I think it's like 19, 20, something like that, but the US
Correct.
is well. I mean, it was like 30 last time I checked. It's only going to go higher. So,
And you look at Warren Buffett, he's been spending a lot of his time in Asia, a lot of it in Japan. But even Warren Buffett, that is like Mr. US stocks, he's spending a lot of his time right now outside the US. He's been selling off a lot of his stocks and a lot of his Apple, a lot of his Bank of America, and he's sitting on more than $300 billion of cash. So that's interesting. So that leads me to exit strategy. So let's talk about exit strategy and what it should look like. So for an older investor like myself, 56, my exit strategy in an expensive market, I'm going to look at the NASDAQ, right? So here's the NASDAQ in 5 years, up 127%. And we had a year where it corrected, and it corrected quite substantially, right? Went down 36%. So this is an expensive market, okay? Now, what's great is I've been an investor since about here. So from here to here, thank you, stock market. I appreciate that appreciation. Along the way, I've had great winners and I've had some losers, but overall, it's been a very positive, experience. But as an older investor, I moved from stocks to a lower risk asset class, bonds being the place of less volatility, less risk. And that's what I'm going to continue to do, probably in greater proportion. I probably have probably about 20% to maybe 23% of my liquid assets, my net worth in liquid assets, not including my real estate, in bonds. Okay. And I have like maybe about 5% in crypto. So bonds and crypto are like 25%, maybe 26%. Then the rest is stocks. And let me take that back. In addition to bonds, crypto, I have cash. I'm sitting on like 12% cash. So I'm up to probably about 35% in alternatives to stocks in my main portfolio. So that's a pretty growth oriented kind of stock based portfolio. I would say in 5 years, it's probably going to be, there's going to be more on the bond side and on the crypto side, maybe up to 40%, maybe 45%. And it'll continue to get bigger. When I'm like 80 years old, it's probably going to be mostly bonds, like 80% bonds and 20% stocks. And that's because at 80, I'm like, whatever. I don't need any more. I don't need any more upside. Now, for a young investor like Tomas, back to you. I hope that you see this experience, right? You see this graph. I would love to see like you make investments in companies. Not all of them are going to be great. Some of them are going to be quite bad. But if you can latch on to, 10 great companies and see them appreciate and compound, this is what I hope for you is you'll wake up later and be sitting on a really, really nice big, portfolio. Okay. Now,
I really hope so.
Now, a young investor, that's an exit strategy. Now, if you are bought into a company, you really believe in it. And the main story about the company has not changed. Uber. Okay. I believe in Uber. Okay. I believe Uber is going to be more valuable in 5 years. I believe they have a lot of advantages, and they're down 7.5%. Now, when they're down like this, it causes me to go look at the company, look at, what was announced, what's going on with their business. Has anything changed? The answer is no. And actually I had an earnings. I reviewed the earnings in detail. I actually think their earnings was really good. So I bought more Uber. So there's no exit strategy on Uber. Now, would there be an exit strategy on a company? Let's look at Airbnb. Now, Airbnb is a big bet for me. It's one of the smaller companies that have a big bet on. And this doesn't really show it all that great. Okay, they had a bad earnings, and it wasn't terrible, but it was not great. Now, this shows it far better. So from here to here, they dropped 25% from July 22nd to August 7th. Now, the story on Airbnb that I believed in is that they're very different in the travel industry. And I think they're using like the sharing economy principles, kind of like the YouTube. You know, YouTube doesn't make any videos. They have people and, you know, video creators make videos. They come to the platform, then YouTube benefits from it. Same thing with Facebook. They don't create any content. The users do. Airbnb doesn't own any real estate. They just have the property owners that come on to Airbnb rent out their properties. So I think that's the kind of company I want to be an investor in. Now, their growth is what concerns me. And where I'm leading to on an exit strategy is if Airbnb doesn't fix the growth problem, I may have to sell some of my Airbnb stock because the story that I invested on is broken. It's fractured in some way. So that would be an exit strategy. That would be an exit. The reason to sell a stock is if the investing thesis, the story behind that stock, if it ends up not happening the way I thought it was going to happen, or if it's broken, then I have to reconsider that investment. If Airbnb can grow at 20%, the story is intact. The story is held together. But unfortunately, they're only growing at like 10%. That's not fast enough because their competitor is Booking, their main competitor. And Booking is doing better than they are. Well, does that mean that Booking is just, they've got a better product? They're doing something better. And I think Airbnb needs to expand their products. They need to sell better internationally. They need to fix the growing problem. As a young investor, I would say exit strategy would be when a company has changed too much for the worse. They've gotten worse. They're like, hey guys, you're not the number one player anymore. Or I'm beginning to suspect you're not going to be the number one player. So that would be a reason why I would sell Airbnb. Does that help, Tomas?
Yes. In fact, I heard you before talking about Uber, and I always thought, okay, what could be my Uber, you know? And I exactly thought about Airbnb, and I made the same comparison. What makes Airbnb better than Booking? I use both, and in my experience as a user, I believe Airbnb has better customer support, and they still have a lot of room to keep growing. You know, they are not as present as Booking in outside Europe and America. They have a lot of countries to keep growing. I don't know why why they don't do it, or if they are trying and they can't, but I believe they have potential.
I agree with you. And, you know, I think, the company that comes to mind is Netflix. Netflix has had periods of time when their growth slowed down. Look at this sell-off, right? Man, Netflix sold off 74% in 2022. Incredible. Just insane. But they had periods when they weren't able to grow, and it's something that you're pinging on, which is Netflix in the US. Obviously, it's really popular. It grew, and then it stopped growing. But then they figured out international. And now Netflix is big in Latin America. It's big in Europe. I mean, it's huge in Europe from what I've gathered, Scott. Love to hear your comments. But so Netflix was able to kind of like, they slowed down and then internationally they expanded and then the stock flourished. Airbnb needs to figure it out like Netflix figured it out. If they don't, they're going to suffer.
You want to hear my comments about Netflix or Airbnb or both?
Netflix. Is Netflix popular in Europe, in your opinion?
Very well. In Switzerland, it's very popular, especially because there's a lot of foreign-born people here, and English is fairly common, especially among the foreign-born people. So yeah, and there's content here. Like there's good and bad. There's some things that come later you can't get here that you could get in the US, but there's also plenty of stuff here that you wouldn't find in the US.
Yeah.
So
Well, I
yes,
watch
it's
a bunch
very
of
popular.
stuff that gets created for UK, like a bunch of good programming. I
Yep.
mean,
They,
The Crown is a UK show that's been huge in the US.
they have deals, I think, with certain production companies and networks. So like I think they have a deal with the BBC to show BBC stuff. Yeah,
Mhm.
it's very good. By the way, isn't Netflix part of the Bill Ackman lore? Like, wasn't that one of his mistakes that he
Huge
bought it the
mistake.
wrong time or sold
So
it the wrong
he
time?
sold. So the company. Okay, so I think Ackman. So the company had a sell off, and Bill Ackman came in, like dressed in white on a white horse, and said, "Oh man, I'm going to invest big into Netflix." And he spent like a lot of money, like I forgot how many billions. And he bought at this point. The stock went here, and he sold. He lost $400 million, and then the stock continued to crater. And then I ended up buying here, and I sold Netflix. I sold them like around here, and I made a great gain. What was my exit strategy? Was I thought their valuation got way ahead of their worth, and I thought their growth was going to be challenged. And in a way, I was right, but from where the stock went, I was wrong. The stock has continued to flourish. So yeah, but Bill Ackman lost 400 million on Netflix around this era. So that's exit strategies for a young investor. Is if you continue to believe in Netflix as an example, it's going to be, just an awesome company. You just keep it. I sold Netflix. Combination was I also own a lot of Google Alphabet, and I believe that Netflix competes with YouTube. They compete against each other for screen time. If you're watching YouTube, you're not watching Netflix. If you're watching Netflix, you're not watching YouTube. So since I own Google Alphabet, and it's my second biggest investment, I was like, well, maybe I can sell Netflix because that's a one-trick pony, where Google Alphabet is a nice diversified business across YouTube, the search business, the Google Cloud business. They have Waymo. So I really like that investment more. The dollars and cents, Netflix did better than Google Alphabet. So I may have been right on kind of my strategy, but I was wrong on price. All right. So we talked about the election, what's going to work next year. Small caps, I think, are going to do well. Looking outside the US market might be a really good idea. India, Latin America, China. I think we talked about cashing out or exiting a stock, and it's different, right? Young investors, we talked about, hey, you don't need the money. So you would exit if you don't believe in that company anymore, or if they have gotten to a point where they're underperforming, they're just really screwing up. So you sell. Older investors, it may be, hey, I need to move my money out of stocks into more stable investments because I want that money over the next 5 years, over the next 10 years. I want to make sure it's there. I don't want to see a lot of volatility because I want to travel, or I want to do something with that money that I really need to be sure it's going to be there. This quantity needs to be there in 5 years. All right. So let's talk about real estate investing just for a minute, since you brought it up a little earlier, Scott. And what I'm going to talk about is, of course, California and US based real estate investing. It's, we are seeing an expensive stock market, and we're seeing a really expensive real estate market. But the good news is inventory of properties available for sale have been increasing in the US. And I think that the prices have gotten so high that only a few people can qualify. And the number of cash buyers have gone away, which is good for if you're looking to buy a property. That means that prices are more reasonable. It's easier to buy a house, but it's still very, very, very challenging. So I still am very cautious about investing in real estate. Now that Trump won, I mean, Trump is self-acclaimed real estate investor, successful one. And I think he's going to do a lot of things to help real estate investors. So it may be a good investment for the next 5 years, but it's just really expensive. Go ahead, Scott.
Just a quick note, something that just occurred to me. So the idea of a wealth tax has been thrown around, and I don't know how likely it would have been if the Democrats had won, but I think certainly now that Republicans very thoroughly won, you can basically say that's a 0% chance of a wealth tax.
I agree.
So that would also go towards what you're saying with real estate.
I agree. Yeah, I think that those who own assets are going to thrive for the next 4 years. Those who make a lot of money are going to thrive over the next 4 years. And, judging from the first term of Trump, I can tell you personally, I probably saved $20,000 to $40,000 in taxes per year. So 4 years, that's like $100,000, $150,000 that stayed in my pockets. Real estate, especially if you have wealth tax or inheritance taxes, the Democrats did, I think, and I don't know how that hurt them or helped them. It just really begins to kind of break some of the spirit, in my opinion. The spirit of the U.S. is, if you really work hard, either you educate yourself and pick a career, you can really flourish. I have personally experienced that. I have siblings who have experienced that. Okay, I came from a poor family. I lived in a poor neighborhood, and I do really well. And my children have been raised in a very good neighborhood, going to the universities they wanted to go to. I paid for it all. Okay, and I have more money than my family needs. That's the American spirit. Okay, and my sisters flourished. When somebody starts tinkering with, hey, well, let's take somebody else's success and start to distribute that wealth to other people, you're really breaking the spirit of what the U.S. to me stands for, which is, hey, if you work, if you're smart, you work hard, you follow laws, you follow the rules, you're kind to your neighbor, you do all the right things, you're going to flourish. As long as that's in place, we're going to continue to do great in the U.S. But when people start to, redistribute wealth, you're going in the wrong direction. It's kind of like you really discourage the people that are like, hey, I'm going to work 60, 70 hours a week for a couple of years, if not for 10 years. Why? Because I want to build a net worth for my family that's transformational. Well, that person should be rewarded because they worked really hard. They took the right risks. They really invested in themselves and their family and their community. They should be rewarded, and you shouldn't disrupt that. As soon as you start taking away from that person and saying, well, you make too much money, we're going to give it to other people for whatever reason, you're discouraging what should be encouraged instead. All right. I apologize for going too far on that.
No, I don't think you did. I think those kinds of conversations are important, at least as long as we want to live in a democracy. Let me just make, I guess, give you a different perspective. I'm not going to say I completely disagree with you, because I certainly don't. But for example, just because people aren't familiar with a wealth tax and you are not a fan of redistributive policies, I would say that it's not necessarily something to be afraid of. So which country, and it's going to be pretty obvious probably, which very developed, very wealthy country, investable country has a wealth tax? Switzerland. But at the same time, it should be logical and reasonable, right? So it's not very high here. It's only above a certain amount, like I think under a couple $100,000 or something, and francs, not dollar. And as you also may know, there's generally no capital gains on stocks here. So that's the other part of it. But I would say that, yeah, I can agree with you. I would also say personally that if it comes to a better society overall, I tend towards that. Now, that could be a conversation for another day. And I also think, yes, that it should be reasonable, and you don't want to hurt your economy, obviously, too much. Sometimes you have to eat some pain in the short term, right? That's kind of the job of the Fed, is to say, hey, sorry, we know that it's going to suck for everyone in the short term, but we got to raise rates, et cetera, right? Anyway, I certainly could go off on a tangent on that, but I just wanted to give you a thought from someone in a country with a wealth tax. Yeah. We are not doing badly here at all. And I pay lower taxes. Here's the thing. I'll leave you with this thought. Despite the wealth tax, I still pay lower taxes than I would in California. So
yeah. Point taken. Perfect. So, and another reason to invest when you're a young person is you can shelter your income from taxes. 401ks, IRAs, Roth IRAs. There are methods, and I'm sure other countries do something similar to encourage people to save up, to invest. I know that's been a mechanism to manage my taxes. And also real estate is a very good tax management opportunity. if you invest in real estate in a particular way, you can really lower your taxes. I would say that, and we can have a whole stream or workshop on real estate investing and how, for example, I'll give you one big example or a simple example that should make a lot of sense. Investor buys an asset for $500,000, and they bought it at the right time, 2010, and they wake up in 2024, and that asset's worth $2 million. So 500,000, $2 million, you have $1.5 million of equity. And you're like, well, if I sell it, I'm going to pay long-term capital gains on 1.5 million. You're like, well, I don't want to pay the taxes. I'm just going to keep riding that investment. Perfect. But then you get smart and you go, but if I borrow against that asset, I pay no tax. And I have a lender that's willing to, lend me, 60% loan to value. 60% loan to value on $2 million would be 1.2 million. The current balance on the first, note is, let's say 500,000 to keep it simple. So I can pull out $700,000 out of that asset tax-free. Of course, I'm going to pay it back, but just the savings in tax is so advantageous. So that's one of the positives of real estate investing if you have an appreciating market and if you're sitting on a lot of equity. And big investors do that left and right, and it's quite lucrative. They keep growing the empire by pulling cash out and never having to pay tax. All right, so good session.
I have so much to say today. I'm sorry for interrupting you so much. I would just like to add one other thing on the real estate. So positive note. And I would also say, don't count out international real estate if you're in the US or anywhere, wherever you are. Because I certainly have American friends, colleagues who have purchased things abroad. Now, it depends on your situation. In their situation, usually they spend some of the year there, or maybe have even moved there full time in some cases. So, but yeah, I just like you can invest in stocks internationally and invest in currency internationally. Investing in real estate internationally, it should certainly not be counted out.
Yeah, good point. I have thought about buying down in Mexico because the prices are like so much lower. It's it's probably 15%. Like if you bought a house here or an apartment or condo and you bought one there, you're paying like 15-20%, like difference between Los Angeles and Mexico City. And it's like, whoa, that's interesting. And maybe put it on Airbnb. So I have thought about that, and maybe someday I'll do it. Then I'll move down to Argentina, do it there, and then go to Switzerland. All kidding aside, the idea to do that in Mexico City or a couple other cities, it's already been an idea that I've been toying around with, but we'll see if someday I do it.
And one last note, real estate in USA, it's insanely expensive. When you compare it with other countries, I cannot believe it. So if you want to do the Mexico real estate stuff, go ahead, Victor. You're going to have a very nice time, even looking at those prices.
Yeah, I mean, it's the one thing that is different is financing is different. I had to learn it, but I believe that if you're going to buy down in Mexico, you're paying cash. You're paying the full amount. Where in the U.S., I think part of the appreciation is that most people, I would say 99% of people finance. They finance a majority of that purchase, like 80% of the purchase is financed. So I think that's the difference in Mexico versus US. But as time goes on, I mean, I go down to Mexico and they're listening to the same music. They're using the same apps. They're driving the same cars. I'm like, well, someday they're probably going to figure out this financing for homes and probably change to that, because then more people can afford to buy a house instead of having full cash. So we'll see. We'll see how it rolls out.
Did you know the 30-year fixed mortgage is, I think, a distinctly American thing? So like
I
here in
didn't know that.
Switzerland, I think the longest is 10-year fixed. Yeah, there was a podcast from NPR. I forget which one. Maybe it was Planet Money or something. But yeah, the 30-year fixed is very distinctly American.
And you see, Scott, it's my opinion that a shorter term, 10 years, I'm going to say that controls prices, because then you're forcing the buyer to really have more equity and to pay off faster. So they're like, I'm not going to buy this massive home. I'm going to buy exactly what I need and what I could afford. In the US, it's like, oh, well, I'm going to finance the darn thing. Heck, I'll put it on a adjustable rate and I'm going to buy the biggest house I could possibly buy. And that's a little risky. So, but that's the American way.
Here in Argentina, before we had the 30 years mortgage system, but after the early 2000s, it disappeared. And now the maximum you can have, and not on houses, but only on land, is 2 years.
What, 2 years?
Yes, no more than that.
Oh, wow, that's tough. See, that would control prices because, again, not a lot of people are walking around with like, oh yeah, I got $100,000 to buy that piece of land. No, it's like, I got $10,000. Okay, I'll finance the rest.
Yes, but that also freezes the market.
It does. The appreciation is just different. It doesn't appreciate, but again, you fix one problem and create another. We'll see how things play out.
One other comment that I really chopping at the bit to give, and it's because of Tomas's point about the U.S. real estate market just being so hot. One of the main causes of that, in recent years certainly, is foreign investors, certainly on the West Coast. And by the way, I'm including Canada because I was visiting, for example, a family maybe a decade ago in Vancouver. And my great aunt was telling me, like, you see those really nice homes over there on the other side of the bay, West Vancouver.
Mm-hmm.
And she's saying that some of those homes are bought by, now I don't want to scapegoat anyone, just doesn't, but this is certainly something that's happened, Chinese investors.
Mm-hmm.
It's also happened in California, right? Kind of a scandal. And people may just buy it as a safe investment and may not even spend any time there at all, may not even rent it out, just buy it as a safe investment. Now, in the Chinese case, part of that is it's not just security, it's also that in China, I believe you still cannot buy outright. You're
Really?
always leasing from the government. Americans a long time, but it's like, it's still just going to be a long-term lease from the government for many decades. And so what's a safe, secure place where there's plenty of other, kindred spirits, and you could go live there if you need to? The West Coast, whether it's US or Canada. But of course, that's just one example. There's plenty of other foreign investors too that see the US as the stable market. So,
how interesting! Yeah, I never knew that.
Yeah, this was a scandal that I saw. There was some report on it, and I'll send it to you if I can find it. That and I don't know how extensive it is now. I think there's been some progress against it, right? But like the other extreme would be, I think Thailand, for example, because I have friends who spend a lot of time in Thailand. I don't think you can buy something there unless you're a citizen or married to one, or something like that. It's very, very hard as a foreigner, even if you live there.
Yeah.
Here in Switzerland, it's in between. So I would be allowed to buy the place I live in. But until I get permanent residence, I could not buy like an investment and rent it out unless I got, I think, special permission. So that's in between. Whereas a place like Thailand, it's really like, forget it unless you become a citizen.
Interesting. That is really, really interesting. I'm going to give that some more thought. But awesome. So, guys, this was an awesome week. I'm just going to call it like it is. I know my portfolio boomed. And I think especially the next like year, I see more reasons why the market's going to keep going up than the stock market's going to give up some of these gains in the next year. Now, after that, what if we were dealt another, couple bad things? Now, I don't think COVID's going to come back, but just to use it as an example, you see how COVID just knocked the stock market over. Like, hey, stock market, that's fine that you're going up, but for now, you're going to go down substantially. And then there might be some other things. For example, the AI bubble, right? Hype. If that thing pops, that could really send a part of the market down. Not saying it's gonna go down. I'm just saying if you saw Nvidia give up half its value and only be a $1.7 trillion company, that is gonna cause that's gonna leave a mark. And so if a couple of things like that happened in 2-3 years, I can see the market, going down. But for the next year, it's this past week, I think the reason why stocks rallied so much is I think people are like seeing more reasons why the market's going to flourish versus there's a potential for a good correction. It's going to get more expensive as it goes up. It's going to get the likelihood of it correcting will continue to rise. And once that correction happens, it will be like 2022, where it'll really overcorrect for some stocks and so forth, but we'll deal with it when that comes. And it's actually going to be a great opportunity, especially for you, Tomas. It's a great opportunity because then you're able to buy awesome companies at a discount. So, all right. So that's a great session, guys. Thanks for tuning in. And we'll have the investor call tomorrow. And just early notice, next weekend, I'm going to be in New York with my wife. We're going to be on vacation. And we're not going to have a call of this type next weekend. And we won't have an investor call on Sunday, a week from tomorrow as well. So next weekend is going to be kind of an off weekend for me. Just a quick notice. All right, guys. Well, enjoy the rest of your weekend. Thanks for tuning in. And I appreciate you. Thank you.
You
All
too.
right, thank
Thanks.
you.
Yeah,
See you
thanks so
tomorrow.
much. Bye, guys.